Hi everyone. Can everyone hear me? Hi. Hi. Hi everyone. Good evening all. Good evening. Hi. Hi. Um, Hi everyone. Hi everyone. Morning. Not morning. I used to take classes in the morning, earlier batch. Evening. Evening. Yeah. Because I do take classes in the morning, 6 a.m. So that's why I've been in the habit of saying good morning everyone. Yeah. Yeah, good evening all. Evening everyone. Okay, guys. Hi. Join fast. Okay. Yeah. So, yeah. So, should we start now? Evening, everyone. Yeah. So, today is the first lecture, and yeah, I'll just give you my intro. One liner, two liner intro is enough. Okay, because we must start the directly hit the topic. That's what I feel, isn't it? So, sir, my name is Vishal Mantri. You might have you might be knowing by now. I was in banking, means I worked in bank. I worked in Citigroup, then I worked with the DBS Development Bank of Singapore, then HDFC Bank earlier. And I worked in all the departments. Means trade finance I've handled for more than 7 years. Handled means not worked, I've handled. So I know that ins and outs of LCs, bank guarantees, then what is UCP 600. I do take classes for CDCS also personally. So means that is for documentary credit. That's a world level exam. And yeah, I've been in banking, corporate banking. I've handled then almost all the 5 to 6 departments which are there in banking. I've handled all of them. I've started from a retail, then went to corporate, then trade finance, some part of treasury back. So almost these are the 5 6 main departments, right? Means I know the pressures of sales also because I've worked for almost 5 to 6 years under sales, HDFC Bank. Those who are in HDFC Bank, anyone who has worked might be knowing the pressure which you come from when you are in retail banking of HDFC Bank. So be rest assured that whatever you'll get is authentic. Okay, and I'll strictly stick to the topics here. My logic is very clear because we have almost 1.5 months for BFM, right? Roughly. So we'll strictly stick to the topic and the portion gets completed. Because this is my, with Adda 24/7, this is my almost 8th batch and almost 23rd, 25th, 26th batch overall. So be rest assured about it. And let's start with the topic then, isn't it? Why to waste the time? Okay. So that much intro is enough, isn't it? Yeah. Anybody who has some doubts, some questions, you can raise your hands and ask the question directly. Okay. Means type the message directly. It'll reach me. Okay. So I'll answer that where, if it is possible immediately, I'll answer that. If later, I'll answer it later also. Okay, not an issue. So let's start with the topic, isn't it? So the first topic for BFM is exchange rates. Can everyone see this slide basically? Can everyone see it? Firstly, answer that because if you are able to see it, if you are able to hear me, then only we should go ahead, isn't it? So yeah, everyone can see it. I'm assuming it now. Okay. Okay. So firstly, we'll start with exchange rates. Now this is a module A. In module A here in BFM, you have basically 4 modules, and mind it, module A and module B are the important ones. Module A and module B. If you understand module B properly, again I'm repeating, if you understand module B properly, module C and D are dependent on B because module C is treasury and module D is that market discipline, balance sheet management. So, see here, actually I'll tell you how the logic goes. Mo- Module A relates to Forex. Generally, totally almost 90% is Forex. Module B, C, and D relate to Basel. Basel means what? Module B relates to this first pillar of Basel 2. Module C relates to second pillar of Basel II, and module D relates to that final pillar of Basel II, right? Means capital requirement is the first pillar, then supervisory review is the second pillar, and the third pillar is that balance sheet management or corporate governance, I call it generally. So if you understand module B properly, module C and D are very easy. Okay, we'll be covering the numericals, we'll be covering the case studies and everything. Okay, let's start with the exchange rates. Okay, exchange rates, the concept of exchange rate arises when you have, firstly, when you have what, if you are dealing in rupee and rupee only, okay, only in rupees. Okay, let me bring the cursor big one here because otherwise it will be difficult for you. Once again, if you are dealing in rupee and rupee only, then there is no concept of exchange rate in that case. Okay, because if I am giving the loan in rupee, taking the deposit in rupee, then what's the problem? The issue of currency exchange occurs when you are exchanging something, right? So here the question comes of what are exchange rates? Exchange rates means when we exchange something. When I exchange the dollar to rupee, now, do we mean that we exchange only dollar to rupee? We exchange anything. See here, when you are in CAIIB, don't restrict yourself or your thinking. And remember, BFM is not related only to banking. BFM is related to anything under the sun which involves risk. Anything under the sun. Okay. So exchange rate involve the risk related to gold also, related to dollar also, related to any commodity also. Everywhere the risk is same. Even stock market. If anybody amongst you deals in this options, okay, either futures or options. Basically, options are the main part. Then there also BFM is applicable. Okay, so exchange rates depend on what? Okay, there are two to three major factors of exchange, two major factors of exchange rates. One is short-term factors. Remember, one is short-term factors and second is long-term factors. Now, all these factors which you are seeing over here, are you able to see this balance of payment, economic growth, fiscal, monetary policy, all these things? Okay, whichever you are seeing, Saurabh, please expand this slide. Okay, slide. I think so. It's visible to everyone, isn't it? Or no? It's visible, na? Everyone. Because it is a full length slide over here. Anyone? Yeah. For others, is it visible? Type yes if you are able to see it properly. This slide. Yeah. Because it's a full length slide. This is the full length slide available. Okay. Okay. See here. These are all long term factors. Remember, balance of payment, economic growth, fiscal policy, monetary policy, and there are two, three more, interest rates and political issues. Okay. Now I'll explain you one by one each term. Because explain you means what? I won't waste your time on getting the details of what is balance of payment and all this thing. No, nothing. One liner explanation enough. So what is balance of payment? See here, there are basically two terms. One is balance of trade and second is balance of payment. Okay, I'll write it over here. BOT. We write it over here. Have I written it over here? No. BOT and BOP. BOP. Okay. So what is the concept behind this balance of trade and balance of payments? Here you might have read is on main screen. Sir, your video is on main screen. This one second. I'll share it again. Let me see. Now is it something different or sir, your video is on main screen, Chandan Kumar. Now you are able to see it, na? Others also? Yeah. Yeah, others are all are typing yes, 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 yes. Able means everybody is able to see the screen properly. I think so. Yeah, isn't it? If any issue, do write to me, guys. Okay. So see here, understand this balance of payment and balance of trade. See here, yeah, the logic is very simple. Balance of payment and balance of trade are nothing but a current account and savings account which we open in our banks. Whenever we open a current account, we open it for business. Same logic is that. Okay. And balance of trade. So balance of trade is always open for business. Okay. So balance of trade is always for business. Business means what? Export and import. For country perspective, it is export and import. Balance of trade. Okay. And balance of payment means what? See here, whatever you get net, suppose if I have 100 rupees of export, okay, 100, and import of rupees, let's say 70. So my net of exports is 30 rupees more. So this net of exports of 30 rupees more will be, understand this sentence properly. This 30 rupees extra which I am having now will be added to balance of payment. Understand this. Balance of trade in the end will be added to balance of payment. Always remember, balance of trade is always the net of balance of trade is always added to balance of payment. Balance of payment is the ultimate thing. Okay. Sir, can click on the PPT slide. PPT slide, it will come on the main screen. Click on the PPT slide. Okay. PPT slide, it will come on the main screen. Okay. So it is there on the main screen only, I think so. Yep. Yeah, is it on the main screen or no? Is it split? Everybody is saying this split only, or are you saying this on the main screen? Everything okay? Everything okay? Yeah, everything is okay for everyone. It's on the main screen only. Okay? Yeah. Okay. So let's move on. Yeah. So balance of trade will always be, in the end, net will be adjusted to balance of payment. Remember this sentence very clearly. Balance of trade is nothing. It's like a current account. Here, if I'm having the current account in your bank, I'm doing the business. And if I earn some profit, so that profit, where will I transfer that profit in the end? I'll transfer it to savings account, isn't it? After all, savings account is my account. Current account is the business account. So whatever I earn in the business, I'll have to transfer it to my profit, isn't it? Savings account. So that's the logic of balance of trade and payment. Okay. Move on. Generally, a surplus leads to stronger currency while deficit leads to weaker currency. These are all long-term factors. Remember this. These all terms which are mentioned over here are long-term factors. So generally, a surplus leads to stronger currency. Means if my exports are more and imports are less, then my currency will be stronger in the long run. Remember, in the long run, it will be more stronger. Okay. In the short run, there's no guarantee of anything, any of these factors affecting the exchange rates in the short run. Remember, short run, the views are totally different. Reasons are totally different. These are all related to very long term. Okay. Next, economic growth. Now, economic growth means what's here? All this make in India, these all concepts are related to balance of payment and economic growth. Economic growth rate, a high rate growth rate leads to rise in imports and fall in the value of the currency and vice versa. Now, what does this logic mean? Here, this is related to a high growth rate leads to rise in imports. How can a high growth rate lead to rise in imports? If my growth is higher, I'll have more exports. So this relates to, this term is given related to short term. Why? Because if I am growing more, I'll need more capital goods. Understand this. I'll be needing more capital goods, and once I need the capital goods, there would be rise in imports for the short term. But in the long run, my country will produce more goods and it will lead to exports. Okay, so ultimately, higher economic growth will lead to higher BOP. Okay, fiscal policy. Now remember, we always get confused between these two policies, fiscal and monetary. In India, there are basically three types of policies. Okay, then the screen can be flipped. BOP explain again. BOP, balance of payment. Okay. See here, balance of trade and balance of payment. Okay, somebody is asking for balance of payment again. See here, balance of trade and balance of payment are like the current account and the savings account. BOT is the current account. We always do export and import in BOT, and whatever we get net of that, that will be adjusted in the BOP. Means suppose if I am having exports of 100 and import of 70, so I am earning more and spending less. So 30 rupees would be my extra. This extra will be in the end transferred to BOP, balance of payment. Okay. So remember, balance of payment is the ultimate thing. BOT is a mediator. Okay. In the middle it is current account, savings account. And also in BOP, other terms are also included here. In this in the world, basically we don't do only business. Suppose if there is FDI, all the NRIs working abroad, they transfer funds to India. Where does that fund reflect? It doesn't reflect in BOT. It reflects in BOP. Balance of payment it reflects. Okay. So BOP is all the remaining terms. Only business export import is included in BOT. Now export import means what? Export import is related to services and goods both. Remember, in India, our services exports are the major ones now. They have overtaken manufacturing goods long back. Okay, so in India, we must always focus on services. And now the problem with the banking system presently, I'll tell you the present problem with the banking system is all our ratio analysis, all the analysis which we have done, those are all related to manufacturing industries. All the ratio, current account, that what current ratio, liquid ratio, then debt equity ratio. Where is the current ratio in a service software company? What is the current ratio? Current asset, current liabilities. What are current assets? No current assets for the software company, right? So we have to gear up. Our banking system is gearing up now for the service industry. Okay, let's move on. Yeah. So I was talking about this fiscal monetary policy. Remember, fiscal and monetary policy. There are three policies basically in India. Okay. One is this fiscal, second is monetary, and third one, anyone knows which is the third policy which is included in India? Which is the third one? Exim policy, exim, export import. Okay. This fiscal policy is given by finance ministry. Keep it very simple. Fiscal policy, finance ministry. Monetary policy, RBI. Exim policy, this commerce industry. Okay. Now for CAIIB, we are only concerned with fiscal and monetary. We are not concerned with that exim policy. Okay. So we won't discuss that to that length. Fiscal policy. An expansionary policy, a lower tax rates can lead to higher economic growth. Now, understand the logic behind fiscal and monetary. Which is the main policy? If someone asks me, which is important, fiscal or monetary? So the answer is fiscal. Fiscal policy is the most important policy in any country's development. Monetary policy is a support to the fiscal policy. Remember, monetary policy is a support. It's not the main policy. Monetary policy is a support to the fiscal policy. Means what? In fiscal policy, the government decides their budgets, their infrastructure development, their all these things, FDI, what FDI to promote, all these things, infra related topics are discussed in fiscal policy. In the budget, means whatever the budget is presented, that's a part of fiscal policy. Then what does the monetary policy do? It supports. Supports means what? If the government wants to do more FDI, then it will, this monetary policy will try to adjust the rupee. Okay. So it will, how will it try to adjust? So now I'll explain that. Firstly, fiscal policy, understand, is expansionary and second is contractionary. Mainly remember, this expansionary and contractionary part is related to monetary policy, mainly. Okay. But even the fiscal policy can be expansionary or this contractionary. How, if for an expansionary policy, remember the tax rates are lowered by the government. Understand this here. Fiscal policy expansionary. I'll write it over here. See this. Where is this pen here? Yeah. Where is it? Yeah, it's over here. Yeah, expansionary. I'll just write it one word for this so that you'll understand. Expansion in fiscal. Fiscal. Okay. So lower the taxes. Lower tax. Okay. Now, second, expansion in monetary. Monetary. Okay. I'll write it monetary. Money only. Monet. Okay. So lower. What to lower in monetary policy then? Lower the rates. Rates means which rates? Repo rate, CRR, all these rates. Both the mainly two rates are concerned with RBI. Repo rate and CRR. Remember, fiscal is related to government. Government can only control taxes. It can't control these rates. Okay, rates are the prerogative of RBI. RBI cannot control taxes because taxes are the prerogative of the government. Be very clear about this. Okay, you need to understand the difference between this fiscal policy and monetary policy. Okay. Okay, got it. Expansionary or contractionary? If it's expansionary, lower the tax. If it's contractionary, increase the tax. Similarly for monetary, the way central bank attempts to influence and control interest and money supply can impact the value of the currency of the country. Okay, so basically what attempts to influence and control interest and money supplies here. Monetary policy will only be concerned about money supply. This interest part is a secondary part. Monetary policy relates to money, 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 only money. Okay. So if they have to increase the money, they'll lower the rates. If they have to decrease the money, they'll increase the rates. What are the two rates which are important in this? The two rates which are important are firstly CRR and secondly repo rates. Okay. Fiscal by government, finance ministry. Okay. Fiscal is by government, finance ministry. Always remember. Okay. Yeah. So coming back, yeah, where was I? This, yeah, monetary policy. Which are the two important rates? If I ask any banker, which are the important rates? I'll definitely tell you. All of you, almost 90% of you, will answer me with 3 to 4 rates: CRR, SLR, bank rate, and what if you understand anything? If you remember repo rate, CRR, SLR, bank rate, repo rate. Remember, all these are not that important. Important one which directly affects the economy or the money is CRR. Directly. CRR increase, direct loan affected. CRR decrease, direct loan affected. Okay. If they increase the CRR, if RBI increases the CRR, what happens? Immediately the loan rates are higher. Repo rate. Repo rate also affect. Repo rate means what? It affects in the long term. Long term means 3 to 4 months. Okay, it affects in that logic. SLR doesn't affect at all any of this. Means day-to-day working is not affected mainly by SLR. Okay, so forget that. And what is bank rate? Anyone knows what is bank rates here? Bank rate and this repo rate, or yeah, bank rate and repo rate basically is here. Low, both the rates. In what does the RBI do in repo rate? What does RBI do in repo? Anyone? RBI gives money in repo, or RBI takes money in repo? Anyone? RBI gives money in repo or RBI takes money in repo? Gives, correct? No, gives. RBI gives money in repo to banks, okay? And it takes money in reverse repo. Remember this. Reverse repo it takes. This repo it gives money, okay? So now okay, a repo you got it, RBI gives money. What is bank rate then? What does RBI do in bank rate? There also RBI gives money. Then you'll say, okay, if both the rates are there and RBI gives money, then why two rates? Why not only one? So it's like this. Understand? See here, understanding is very important. Okay. Uh, Personal loan and collateral loan, housing loan and personal loan. Which rate will be higher? Housing loan or personal loan? Which rate will be higher? Logically, the rate which will be higher is what? Personal loan. Why? Because no collateral. Same logic. Bank rate, no collateral. Bank rate, no collateral. So personal loan rates would be higher. Always see the bank rate for RBI is always higher than the repo rate, because repo is like a collateral. RBI takes that promissory note from you, from the banker. Okay, so repo rate will always be lesser and bank rate will always be higher. So that's the logic. See here, everywhere, anywhere you go in the world, you do any type of banking, retail banking, trade, corporate banking, RBI banking, say, IMF banking, World Bank, anything. There are only 2 to 3 important terms. One is personal loan and collateral loan. Simple, first term. Second is CC or term loan. These are the only two types of loans which are used throughout the world. You give any name, you give the name of what, that packing credit, pre-shipment credit, post-shipment finance, then what, any name, but after all it's only OD or term loan. That's it. Even IMF works on the business, on the system of this personal loan and this collateral loan only. Okay, actually IMF and World Bank work on the chit fund scheme. Chit fund, right? You deposit the money with them and they give the money to you whenever there's any need, and they charge and they charge the interest also on that. We are not concerned with that. None of our studies part of it. Okay, as of now. Okay, let's move on. So monetary policy clear. Okay. So attempts to influence and control interest rate and money supply can impact the value of the currency of the of the country. Okay. Interest rates. So higher domestic interest rates tend to attract overseas capital than, thus the currency appreciates in the short term. Now what does it mean? Interest rates higher means what? Okay. What do you mean by interest rate? Interest rate means, basically remember, important part is repo and bank rate. Now if you check the repo rate of India and if you check the repo rate of USA, there is a huge difference. The difference is roughly 2%, means more than 2% actually, I would say. But roughly, because now last 3 months, last month they had increased, and this month also they had increased their rates. Anyone knows what has happened in USA now? What the weightage of the modules? Okay, I'll tell that later. Okay, weightage of the modules. Definitely, I'll tell that. Okay. So what has happened in US? Anybody can tell me what has happened because this is related to BFM. See here, what has US done in last this month as well as in last month? I think so. Yeah, both in both the durations they have increased their bank rate, or they are basically rates, interest rates they call it. They have increased their interest rates by 0.75% two times. So what has happened? This interest rate, now if they increase the interest rate, what happens? The current, always remember, the money always flows from lower interest rate country to higher interest rate country. Logic is very clear. So why does India get so much FDI, foreign direct investment, and FII investment? FPI we call it. Why does India get that much investment? Because the interest rates in India are higher. All the developing countries, the interest rates are higher than the developed countries. But remember, India is not a developing country anymore. India is a developed country now, to that range. Okay, because we are almost in the first five economies of the world. Okay, but then also our interest rates are higher than that of the US. So what happens if the higher domestic interest rates tend to attract more overseas capital? So FDI flows more in the countries where the interest rates are higher. Okay. But then you'll ask me one question: why doesn't fund flow more in Sri Lanka and Pakistan or any of the neighboring countries of ours? Because even though they guarantee higher interest rates, but people don't trust them. That is the problem. Okay. Thus, the currency appreciates in the short term. So, if more FDI is required, okay, one more FDI comes in, so the currency will definitely appreciate in the short term. Okay, so everyone will require rupee. So dollars come in and they require more rupee. So is here, how does the logic moves? Understand this first. Thus, the currency appreciates in the short term. In long term, however, the interest rates slow down the economy, thus weakening the currency. So if the higher interest rates are there, so it will slow down the economy. Why does it slow down the economy? Is here. Now I think so in BFM or ABM. ABM, you might have studied this ISLM curve. Anyone has studied this IS and LM curve, right? What was that? IS, it was like this. IS was like this. IS, right? Anyone studied that? IS, and second one was this LM. LM, right? And here it was growth, GDP. Okay, growth, and here it was rates, right? Anyone remembers that? Yeah, last month you have attended that class, isn't it? IS and LM. So always remember, if the interest rates are higher, always remember this logic. If the interest rates are higher, businessmen, this is always related to LMs here. Logic is very clear in ISLM curve. IS curve means it is related to savers, you and me. Saver, you and me, who save, earn from the salary, save in the bank or in the mutual fund. LM relates to businessmen. LM equals to businessmen. So businessmen. So what happens by the businessman? If the interest rates goes up, see this R goes up, what happens? This businessman will try to not building the business. So he'll try to reduce his business if the interest rate goes up. So that's why higher the interest rate, slow the economy, and lower the interest rates, faster the economy grows. Okay, logic is that clear. Always here, always remember this ISLM curve is the most important curve, most important. Okay, most important curve in any economy. Nothing. RBI decides CRR based on ISLM curve. RBI decides repo rate based on ISLM curve. Any rate by any central bank is decided based on ISLM curve only. So that's why I study that in ABM very clearly. Okay. Next, political issues. Political issues means same thing which are seeing now in Sri Lanka, Pakistan, Venezuela, and this Latin American countries. All these things, everything's political issues. Okay, so political stability is likely to lead the economic stability. Logic clear, and hence steady currency. While the political instability will have the opposite effect, isn't it? See here, always remember, political issues are the main issues in any country. Will you suppose if I tell you tomorrow invest some in Afghanistan? Somebody is giving you very high rates. Will you invest? No. You'll say, what is this foolishness? I tell you tomorrow invest in Sri Lanka, getting some higher rates. Will you invest? No. Right? What is the rate of Sri Lankan rupee now? Roughly, I'd seen something 286, 300 somewhere was the rate. Okay. Similar, no, I think it was more higher. And Pakistani rupee has gone to much higher rate now versus the dollar. Why? Because of political instability. Always remember there is something called as pestle analysis. Pestle means what? Political, economic, social, technological, environmental, and legal. Always keep these seven, this pestle word in your mind throughout your life. Okay? Because pestle will tell you anywhere you do, even if you invest somewhere, you might